So there's four stock options trading strategies that are definitely going to make millionaires in the next 90 days. And maybe you've heard of these strategies before, and maybe you have not, but I could pretty much guarantee you this. By the end of this video, you're going to understand how stock options actually work. It's not what you see online. It's not about buying a call option before a company reports earnings and just hoping they blow the earnings out of the park. That is not how you do stock options. That is gambling. You are going to learn the right way to do stock options, and we're going to rank these by the hardest to make money to the easiest to make money. And this is exactly how I scaled my account to over $1.2 million in just a few years by doing stock options the right way. So the first thing that we're going to start off on is buying a put option. And when you buy a put option, you're just really expecting the stock price to go down. But the problem with buying a put option is it's the hardest thing to make money on. So let's just take Apple here as an example. The stock is up over 112% in the last 5 years. And if we just break this down by what does Tim Cook, the CEO of the company, want? They want to increase revenue, increase earnings per share, make the company more profitable, make it more efficient, and really just bring new products to market to make the company bigger, better, and stronger in the future. So when you're buying a put option, especially if you buy a long duration put option, like maybe a 1 year put, you're betting against all that. You're betting against the CEO, you're betting against the board, you're betting against the employees, you're betting against the shareholders. So that's why you could make a lot of money buying put options, but it is one of the strategies that is actually the hardest thing to do. Because again, yes, there's a lot of volatility on Apple through this whole time period of 5 years. But how are you personally going to know that, oh, Apple's going to fall from here to here on this time frame right here? It's really hard to do that. So when I buy put options, I usually don't go way out on my expiration dates. I'll maybe go like 6 months at a maximum because remember that tailwind of these companies, they're trying to grow, they're trying to become bigger. And the longer that you go out on these put options, the more that you're betting against a company for, and the more that you're betting against a horse that's probably going to win the race, the more that you're likely to lose. So that is why long duration put options is very, very tough. And to build on that time frame thing, there's this thing called theta, where basically every day that a contract goes by, it's going to be worth less in value because there's less time for something to happen. So let's just say that right here you buy a put option on Apple because you're like, oh yeah, it's going to go down. But maybe your expiration date only goes till the end of my cursor right here and you don't really make any money. But if you would have extended a little bit longer, you would have been able to capture this dip right here and you caught that, 26% drop. But maybe your expiration date only goes to here and maybe it's just a break even and that contract's probably just going to expire worthless. So the point that I'm getting at is this. You have to get the timing right when you buy put options. And if you don't, you're going to get smoked. You're going to lose money. It's very, very tough to time this just right. It's very hard to time the top of the market or any stock in general. So the other thing that really matters too when you're buying a put option is the sentiment. When you're buying a put option when the market is falling, like when Apple was on this dip in April, what do the average investors want to do? What does the herd want to do? They want to go buy put options. And when they want to go buy put options, there's more demand to buy that put option. Therefore, the premium is going to be higher. They're paying more for that same contract. So, do you want to pay more for the same thing? Probably not. So, you have to buy put options when you're really going against the tide. You're kind of taking this contrarian look on the market. You don't want to go buy when everyone's going and buying them because you're just going to pay too much. And that kind of builds into the implied volatility. If there's a lot of implied volatility, which is, when the market dipped here for tariffs, everything pretty much went down, but the implied volatility went up a lot. And when implied volatility is high, again, people are willing to pay more for a put option because the stock is expected to move a lot more than what it typically would do. So again, you could make a lot of money buying put options. I have made a lot of money buying put options in my day before too. But I will just say that it's a strategy that I do not use often because, again, it's just so hard to do. All right, so strategy number two, and again, we're going from the hardest strategy to make money with to the strategy that is basically like almost guaranteed to make money with if you do it right. We're going to get to that one in just a minute, but we're going to start off on number three right now. Buying the put was number four on the hardest scale. Number three is going to be buying a call. And you're going to be like, Brandon, buying a call option. I know this strategy, but you're probably not thinking about it this way. Just let me get through this a little bit here. And you're really going to realize like, geez, I'm gambling with call options. Why don't I do this stuff the right way? So as we were talking about with buying a put option, what does the CEO of Apple want to do? What does Tim Cook want the company of Apple to do? He wants it to be more valuable. So if you call up Tim Cook on a phone and say, yo, Tim, can you make the value of Apple higher in a week from right now? He's going to say, dude, no, I can't do it in a week. Well, what about a month? No, dude, I can't do it in a month. But what if you give him a year or a year and a half or maybe 2 years to make Apple more valuable? Do you think he would probably say yes? The answer is yes, because you have so much more time to make the company more valuable. You could put a new product out. You could make the new folding flip phone to compete with the Samsung one. You just have time to make the company more valuable. So I see online a bunch of people that buy these like 2 week call options and they're just totally gambling and speculating on, well, when is the stock market going to go up? When is the market going to go down? When is Apple going to just bounce around like a freaking vibrating machine? Like stocks in the short term, it's very, very hard to know what the price is going to do. And again, when you're buying an option, buying a put or buying a call, what does theta do for you? Every day that goes by, like let's just say that you buy a call option right here on Apple. Let's just say you got this momentum, you're riding the hype, and you're like, I'm going to buy a call option and I'm going to take my expiration date out to right here. The stock's down 16%. You lost money on a call option. That thing's going to expire worthless because the stock didn't go up. But what if you would have taken that option out all the way to the current time right now? You would then be up 27%. So that's why timing on options is very, very critical, especially when you buy options. But when I do buy options, when I buy call options specifically, I usually go longer duration. I often do like a leap, where that's basically just an option that's longer than 1 year in duration. And the thing that not many people really know about with buying a leap option is that if you truly hold it for more than 1 year, it'll get treated as long term capital gains, which is great. Long term capital gains are way lower than your ordinary income tax rate. So, again, this is ranked number 3 on the hardness scale because it's obviously not as hard as buying a put, but it's not as easy as the other 2 option strategies that I'm going to show you. Because, again, you have to get the timing right. You have to get the share price to go up, and it has to go up quickly. Because if it doesn't, theta is going to get you, the sentiment's going to get you, maybe implied volatility is going to get you. You're just going to get wiped out on buying options. And again, buying options is kind of like swinging for a home run. You can make a lot of money, but you could also lose a lot of money, which you could just lose what you pay for the premium on that. But let's talk about the third strategy, which is going to be selling calls and specifically selling cover calls. I usually will never sell naked calls because your risk is going to be unlimited, but selling calls is basically something that you would do is if you hold the stock of Apple, for example, and maybe you still want to hold the stock for the long run, but you just feel like locally it's expensive. So let's just say that right here we feel like Apple, it's not sustainable. The stock price is going to the moon. I'm going to sell a call. Now let's think about a couple things right here. What is a typical ding dong investor thinking about right here when Apple's pretty much going to the moon? Oh my God, it's going to keep going. The stock's going to keep going up. I don't even know if stocks could ever go red again because they're just going green and I don't see how they could go red. So that's how people actually think. And when they think like that, what are they thinking about doing? They're thinking about buying call options. But Brandon, we're selling call options right now. What does that have to do with buying call options? Well, remember what I said earlier, how when there's more demand to go buy something, the price of that goes up. So when there's a bunch of people, the herd is going and buying these call options, we are then going to sell them those call options for a higher premium because, again, they're willing to pay more for the same thing. So we just collect a bigger premium, and we're collecting that premium after the stock just ran up a lot. So there's a good chance that it's going to take a little bit of a breather. So maybe you sold some call options when Apple was up here around 260 and you just took it out to the current time in the market. The stock is down 2.6%, but guess what? That option is going to expire worthless because the share price did not go up above the strike price. And whenever I sell call options, I'll usually always do a strike price, 10-15% higher than what it's currently at right now, just to give me that buffer. And the duration, again, we got to be careful on duration for selling calls because you're kind of betting against a company. It's kind of like buying a put option, because you just don't want the share price to go up or go up a lot. You can maybe have it go up a little bit, but optimally you want it to go flat or go down a little bit so that that contract's going to go down in value, it's going to lose money, and you could just buy it back at a cheaper price. Because remember, selling a call option, maybe we sell this option and collect $10,000 in premium. We want that contract to expire worthless, or we just want to buy it back for a cheaper price. And oftentimes when I sell options, particularly selling call options, maybe I sell it for 10K and I buy it back for 5K. Hey, I just made $5,000. I could take that 5K and just go buy something else with that I'm bullish on. So selling options is a lot easier because, again, you don't have the time factor going against you on this, that theta time decay. Theta is actually going for you on this because every day that goes by through this time frame right here, there's less time left in the contract. And less time in a contract means there's less time for something to happen. Less time for something to happen means that the contract is going to go down in value pretty much every single day. And again, the sentiment, we are selling these options when the market is pumping, when the market is going to the moon. that is a good time to sell options, specifically selling call options. But you don't just want to go sell call options just because a stock went up. Like if we just go to Nvidia right here, there's so many people that were selling call options on this pump right here. And, they had their shares for 16 bucks a share. Maybe they sold a $47 call. Their shares got called away from them right here, but then they missed this huge run. And the thing about it is, earnings per share is what moves the price of a stock in the long term. This is a 5-year chart. We could look up and see what Nvidia's earnings per share did in the same time frame, but I could promise you the earnings per share chart looks very, very similar to the stock price chart. So, just because the share price is going up, it doesn't mean it's an automatic sell your options on it right there for selling calls. You have to be very careful with this stuff because you don't want to limit your upside to the stock. You don't want to cap your potential gains by just selling calls. And another thing that I could say about selling calls is, it's a bearish slash neutral play. So if you're bearish or neutral on something in your portfolio, why are you even holding that stock in a get-go? Why don't you just go sell the stock straight up? Because maybe the stock is going to fall 50%, but then you see the people online that collected 2% of the equivalence of the share price, and they're like, oh, I'm a genius, I'm selling calls, I'm collecting cash flow, but then the stock falls 50%. So don't get caught up in that non-needle mover stuff. If you think the stock is extremely overvalued and you think it's a bubble, just sell your dang stock, take the profit, and go buy something with a better risk-adjusted return. Okay, we did 4, which is buying the put. We did 3, which is buying the call. We did number 2, which is selling the call. Now, number 1, and this is how I, on average, generate roughly $30,000 a month. Some months are more, some months are less. It really just depends on what the market's doing. This is selling put options, and this is honestly like the biggest hack to the entire stock market that I've ever found in my entire life. The strategy that I use, it's over a decade into making, and it's crazy how good that it works. So let's just look at Triple Q, for example, here. You can see that 5-year chart's up over 108%. Now, Triple Q is an ETF. There's roughly 100 companies in there. It's tech heavy. We get it. What does all those CEOs want the share price to do? They want it to go up. Boost revenue, boost earnings per share. You get it. So in the long term, do we think that Triple Q is going to trend up in the long term? Yes. But do we think that Triple Q is going to be very bumpy along the way? Yes, of course. So let's just take a look at something right here. Triple Q fell from 2022 to the bottom right there, roughly 36%. But then Triple Q made a massive run coming off of this base right here, going up roughly 131%. Crazy move right there, by the way. Stock market, it's been on a complete tear. But my point is this. As Triple Q's falling in price, what is a typical ding-dong investor doing and what are they thinking right here? I'm scared. The market's going to crash. It's going to keep going down. America's going to fail. Interest rates are going up. Inflation's out of control. What on earth are we going to do? They're scared. What do they want to do? They want to go buy put options. They want that downside protection. The sentiment's bad. The vibes are bad. They just don't want to be involved in the stock market and they just want to hedge their portfolios. So they're buying put options. Now, what am I doing in this time frame right here? I'm selling them put options, and I'm not selling them put options for like a 1-month expiration date. When the market was on this low right here, I was selling put options with roughly like a 1 to 2 year expiration date. And let me explain to you my logic behind this. And this is honestly like really, really debated in the community, but I promise you, let me explain this. I'll give you my logic, and you're gonna be like, oh, that actually makes sense, dude. So let's just say that, the typical person, they're gonna sell a 1-month put right here. Are they going to make money on the 1-month put? Yes, of course. So let's say that you sell a 1-month put and you collect $1,000 in premium. You're going to do just fine. You collected $1,000 in premium. But let's just say that I sell a 1-year put and we'll just times it by 12 and say I collected $12,000 in premium. Great. I'm going to make money too because obviously Triple Q is up 12 months from right now. But my point is this. You generated $1,000 in premium when the market was cheap. I generated $12,000 in premium when the market was cheap. So what am I going to do with that premium? I'm going to take the $12K and I'm going to buy calls or I'm going to buy shares and I'm loading up my portfolio at the bottom when the market is cheap. But the person that's selling those 1-month put contracts, you do not have the luxury to continue to generate all that cash flow at the bottom of the market. If you're looking at my screen right now, or maybe you're just listening in, I'm showing you right now what 1 year is on this chart. Takes you out to roughly right here. 1 year out, the market already made a 55% move. So as you're selling your little 1-month puts as the market's going up, which right here, you probably would have had to roll it down and out a couple times because the market did trend down, I caught a 55% move on triple Q on my call options that I bought right here. So you're leaving so much money on the table because you're impatient and you feel like more trades equals more money. I'm going to make less trades, have less headache, and I'm going to make a lot more money than what you're actually going to make doing your monthly options. But I promise you, when I sell puts, and I was just doing it right here on this April low, I was selling puts on AMD, Nvidia, TSM, Meta, there's a bunch of companies I was selling puts on, and I took the money and I was buying call options. And I was doing like 2.5 year contracts because I was generating fat premium right here. And just a couple months later, those put contracts that I was selling, they were up like 75%. And I only held them for like 2 or 3 months. So I held them for 2 to 3 months, and there was like 2 years left in the contract, but I already realized like 75% of the profit. So that's where the big money is made. It's not only the theta that really made that contract go down in value, but the share price went up and the sentiment flipped. People were paying top dollar for put options down here when the market was on the dippy, and I was selling it. So that's why sentiment is big. You got to really understand what the market's doing, the valuation level. I don't claim the market fell to an extremely cheap level right here, but I do claim that there were some deals and it was a time to make some plays. And that's exactly what I did right there. So hopefully you got value from this video. Definitely go like and subscribe. And if you kind of like what I talked about here, you definitely want to go check out my course. It's free for the first few days to get in there. You get course and Discord access. Other than that, I'll see you guys in the next video. Have a good night.